What's up, guys? This is part 2 of our 3-part deep dive into Alibaba's Q1 fiscal year 2023 results. And in this video, we're going to cover local consumer services and the cloud business. And there's a lot to get through. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this one. So of course, this is part 2, and here's where we're going to cover all the other segments. But the 2 segments that I believe are going to require the most attention are their local consumer services. That's like their deliveries, so to home and to destination delivery businesses, and their cloud business. And I know a lot of people are very interested in Alibaba's cloud. I know a lot of you guys, your main thesis into buying Alibaba is the cloud business, and so I will cover that in detail. And so overall, here are the segments broken out. I did expect a disastrous result in local consumer services due to the CCP price reductions and lockdowns, but it really performed well in spite of those headwinds. So I was really surprised to see year-over-year revenue growth and a decline in the adjusted EBITDA margin. So they're more profitable and have grown revenue. That's crazy to me, and I want more of an explanation than they've provided in their financials, but I'll dive into that a little bit more. And then cloud shouldn't be growing this slow. I think a 10% year-over-year growth for cloud is really slow, especially relative to their North American counterparts, but it's only one quarter, so let's see how this plays out. But I got some bad news from cloud, and I'm going to share that in a second. So with local consumer services, you can see that they were actually able to grow revenues primarily through the use of more efficient subsidies that were contra revenue for LE.me. Now, I don't know if those subsidies were vouchers given to consumers. I don't think that would be a contra revenue type subsidy, but I would love more information on what happened in this segment. Were they just given subsidies to hire more workers, and then the CCP covered that on the back end? I don't actually know what happened there or what caused that revenue to go up. And so I would like a little bit more information there. So I hope they do provide that. Now, just moving into this segment EBITDA, notice that LE.me's unit economics per order were actually positive during the June quarter due to increased average order value, as well as their optimization of their user acquisition spending and reducing their delivery cost per order. So effectively, this business is just overall doing better. They found a way to reduce the cost overall of getting the product to the consumers' homes. But remember, guys, from the Alibaba Investor Day series, I did mention how LE.me is really losing ground to Meituan. So I just don't think they win in this segment overall, but it's good to see that they're doing well. Now, there are people that say, listen, a rising tide will lift all the boats, and that's sort of the bet here. And so I do think that they will make this segment profitable, and it'll be okay, but I just don't think that they'll catch up to Meituan, especially with the lead and gaining lead that Meituan has over LE.me. Now let's jump into the cloud segment. So overall, the decline in the cloud segment was 10% quarter over quarter. Part of that was due to losing ByteDance, which is the owner of TikTok. But the other issue is, notice how the CCP actions have impacted the cloud segment. So online education customers declined, as well as softening demand from other customers in China's internet industries. And so my question is, what is causing that softening demand? Is it just the overall economy declining? Or does it mean that companies are using state-backed providers more? Or is it a bit of a combination of the both? And I actually think it's a bit of a combination of both. I think cloud is being challenged right now because you have vendors that are saying, hey, listen, we don't want to risk any data security issues, so let's just go with the state-backed providers. And you also have a double whammy of a slowing economy, due in part to continued COVID restrictions, but also just in part to a slowing global economy as a whole. Now, in terms of adjusted EBITDA, the adjusted EBITDA margin declined slightly, which is due to increased investments. But overall, it's nice to see that the segment still remains profitable, but it's way off of where it effectively needs to get to, which is a profit margin of, I would say, at least in the 15 to 20% area. Now, here's a challenging thing that's happening with cloud. There was an article put out by the Financial Times, and effectively what they're doing is they're predicting doom and gloom for Alibaba and Tencent with their cloud business. And effectively, they're saying that these Chinese tech giants are lagging behind their US rivals as Beijing favors state vendors. So that's scary. And so what they're effectively saying is that growth is slowing and profitability still lags the global leader, which is AWS, Baba does have the ability to focus on more profitability instead of growth. And I do believe that that's the direction that they're going to go down. That is a direction that Tencent actually went down. So Tencent is not actually competing for revenue growth anymore or market share. They're competing to make this business more profitable. And I do believe that that's the direction that Alibaba is going to have to go as well, which means that their number one position of overall market dominance could go away. And this is what I mean about the two-pronged challenges. So lots of small internet companies with less than 100 people have closed this year. So that, of course, would hurt Alibaba's cloud division. The other issue is that competition is heating up, which is slowing demand. And part of that heating up competition is that people are switching over to state-backed providers. And what I did want to point out to you is that Alibaba always mentions that the internet business or industry is slowing. Notice that the internet industry is 50% of the overall cloud industry right now. But the other thing I want to point out is only 12.3% of the overall industry is government. So if that part goes away, Alibaba still has access to a significant amount of the overall industry, and the industry is going to grow away from internet as well. It's going to go into other industries. So there's still a lot of room for growth, which is why I do believe that Alibaba's cloud business's revenues will still grow into the future. I just believe that they may potentially grow slower. And what do I mean by that? Well, notice here, with rising competition from telecoms and Huawei, Tencent and Alibaba are shifting away from low value added private cloud work. They are focusing on higher margin cloud services, and Bernstein expects slower growth in the next few quarters, which is what we're starting to see now. And there are several local governments, such as the city of Changsha, guys, let me know how to pronounce that in the comments, awarded renewals to Huawei in no bid competitions, but the tenders showed fewer automatic deals for Alibaba and Tencent. So that's scary. And what that leads me to conclude is that we are in a new era for cloud in China. Private vendors will have to compete on higher margin, more complicated solution space and leave the low-hanging fruit for the state-backed providers. This means that Baba's market share could likely go away. But what does that mean in terms of growth rates? Well, I'm forecasting a 15% overall growth rate beyond 2024, but I think even a 15% annual growth rate may be too high in this environment. So guys, let me know in the comments what you guys are forecasting as you forecast this business out. But, you know, as of last year, they finished the year at 75 million RMB. And I still do believe that this business will grow up to 300 million RMB by the end of fiscal year 2032. So there's still a huge growth trajectory. I just don't think that it's going to be growing at the rate that we were originally thinking that this was going to grow at, which was at least a minimum of 25% annual. And so how did I get to that 15%? I didn't just pluck that out of the air. Notice that there's a report here from Canalys. Growth for the cloud industry as a whole is slowing. And you can see that in this chart here, but I do believe that there's going to be a point where it bottoms, and I think that that's around that 15% annual mark, which is why I forecasted Baba out at 15% annual growth. Now, I do believe that because this chart is showing that it's going down to around 20%, if Alibaba is losing a little bit of market share to the state-backed people, then are they growing slower than the overall market? I think that's the direction that this is going. So that's another reason why I got to that 15% number. Now, overall, you can see that Alibaba still owns 36.7% of the cloud industry as of Q1 of 2022, but I do believe that they just hold the crown for now. Now, I do want to show you guys something interesting. So I did create a brand new Alibaba model, which is extremely granular, and it builds out the revenue and adjusted EBITDA for each of the segments. So it's really cool to sort of value this thing out. But I wanted to show you the segments that we covered quickly in this part 2 of the Alibaba Q1 fiscal year 2023 analysis. So you can see here that for local consumer services, I'm forecasting fiscal year 2023 to grow at around 5%. Sinyao is around 0%. Cloud is 10%, digital media, entertainment, and innovation. I think those segments are going backwards. And then moving forward, I'm growing local consumer services at 5%. That, once again, might be a little bit too low. Sinyao is growing at 10%, which aligns with the total China commerce because it's complementary to the total China commerce. So I'd want those two segments to effectively grow at the same rates. And then cloud, I'm growing out at 15%. I already explained to you why I'm growing cloud at 15%. But effectively what I'm telling you guys is that there's a lot of pessimism or conservatism in this model. And so just like how I explained in part 1 of this 3-part series that there was conservatism built in the model up above, there's also conservatism built in this below. And you guys remember that I showed you a valuation of approximately $300 per share. We can absolutely get that valuation to $400 to $500 per share if we increase these revenue expectations, but I'm just not comfortable doing that right now. And it doesn't change the story that I do believe Alibaba is cheap. Now, what does the valuation look like? As you recall, the free cash flow per share valuation net of the forecasted stock-based compensation is approximately $300 per share. Now, if you don't understand that stock-based compensation comment, go back and watch part 1 where I explain how I adjust out the expected stock-based compensation from the free cash flow per share to determine how much free cash flow per share the owners actually get. And so based on that valuation, I still believe that Alibaba is very undervalued in this environment based on the current share price. But like I always say, it's just my analysis. It's never an investment recommendation. Always talk to your advisor. Now, how do you get access to that brand new Alibaba model? Well, you can get access to all of my models, including the tracker, at the lower tier of the Patreons. And if you want to join us for a live epic presentation each month, which I reserve my very best work for, you can join us at the upper tier of the Patreons. Now, if you missed part 1 of this Alibaba series, I'm going to link to that up above right here. And below it, if you want a refresher on the Alibaba Investor Day series, I actually link to that below right here as well.